This is the Strifor channel, and today we're diving into the darkest depths of the cryptocurrency world. If you've ever felt like the market is playing against you, if you've had the sensation that someone knows your next moves in advance, you're absolutely right. Imagine a chess game where you can only see your own pieces, while your opponent observes the entire board from above. This is exactly what the cryptocurrency market looks like for an ordinary trader. Today, we'll lift the veil of secrecy over how this game actually works. So welcome to the world of manipulations, thin order books, and whales, where every click you make can be predicted and every price movement has a hidden purpose. Why the crypto market isn't what you think. When you open your trading terminal and see familiar charts, candles, and indicators, it creates the illusion of a civilized market. It seems like the same laws apply here as on the New York Stock Exchange or NASDAQ. But this is merely superficial similarity. Imagine two cities. The first is New York with its skyscrapers, traffic rules, and police on every corner. The second is a Wild West town, dusty streets where the law is established by whoever has more gold and a faster gun. Traditional exchanges are New York. Regulators work here, every transaction is monitored, and there are clear rules of the game. Trading volumes are so enormous that even a billion-dollar trade cannot drastically change the price. The crypto market is the Wild West, young, uncontrolled, fragmented. Regulation is either absent or radically different across jurisdictions. Most importantly, here, one large order can change an asset's price by 20, 30, even 50% within minutes. This chaos creates the perfect environment for those who know how to exploit it. And these people aren't mythical creatures, they're real, and their strategies can be studied and understood. Now let's talk about something most traders see every day, but don't fully understand: the order book. The order book is like a store window displaying all the desires of buyers and sellers. At the top, those ready to sell higher. At the bottom, those ready to buy cheaper. Between them lies the current price, constantly changing. In traditional assets, Apple stocks, gold, oil, this order book resembles a massive wall. Thousands of participants, millions of dollars at each level. Moving the price requires truly colossal efforts. But open the order book of any altcoin, even from the top 100, and you'll see a completely different picture. Voids gape between price levels. There's enough liquidity for just a few large orders, and beyond that, an abyss. Imagine walking across a bridge. In traditional markets, you have solid steel beams beneath you. You can jump, dance, the bridge will hold. In crypto markets, you have thin wooden planks beneath you. One careless move, and you fall into the abyss. This is where things get interesting. An experienced player knows where these weak spots are located. They see that between $42,000 and $41,500 for Bitcoin, there are virtually no buy orders. Then they make a calculated move. One large sell order, and the price simply falls through the empty levels. Automatic stop losses trigger, creating a snowball effect. Panic builds. Meanwhile, they're already placing buy orders at the bottom, collecting cheap assets from those selling in panic. Whales, who they are and how they think. Let's meet the main characters of our story, the whales. These aren't just people with big money. This is a special cast of players who think completely differently. An ordinary trader sees a chart and thinks, oh, price broke through resistance, time to buy. A whale sees the same chart and thinks, excellent, now everyone will start buying. Perfect time to sell. Whales never follow the crowd. They always go against it, but they do so with surgical precision. Take a typical situation. Bitcoin has been trading in the $40,000 to $42,000 range for several weeks. Everyone is waiting for a breakout. Analysts draw triangles, talk about volatility compression. During this time, the whale patiently accumulates a position, but not with one big order. That would be too obvious. They split their purchase into hundreds of small orders, spreading them over time. Algorithms help mask the activity as ordinary trading. Weeks pass unnoticed. The market is boring, volumes are low, most traders either wait or trade within the range with small profits. Suddenly, a breakout. Price sharply moves up, breaking through $42,000. All indicators scream, buy! News channels write about the beginning of a new bull trend. FOMO captures the market. But the whale is no longer buying. They're selling. That very position they accumulated for months, they dump in a few hours, while everyone else buys in euphoria. Then comes the reverse breakout. Price returns to the range, then breaks it downward. Those who bought on the breakout citing losses while the whale is already planning the next accumulation cycle. This isn't malicious intent, it's business. Harsh, calculated, but predictable if you know its rules. If you're interested in the crypto market, take a look at CFDs. Contracts for difference provide flexibility. You can trade not only on price rises, but also on falls. No wallets, no blocks, no asset transfers. Just the market and the decision to enter or exit. On the Strifor platform, dozens of crypto pairs, fast execution, leverage, and clear conditions without hidden fees. And if you want to earn even outside of trading, we have a partner program with rewards up to 60% of commission from attracted users. Create an account, test the platform, and decide for yourself whether this format of working with crypto suits you. The link is as always in the description. Let's move on. Games between exchanges, how the illusion of movement is created. Now let's talk about what happens behind the scenes of the crypto market. Liquidity flows between exchanges and assets. Many think that Bitcoin or Ethereum prices are the same everywhere, but that's not true. Each exchange has its own microclimate, its own liquidity, its own trading peculiarities. Binance with huge volumes and deep order books, FTX with advanced derivatives, numerous small exchanges with thin liquidity. An experienced whale knows this and uses it as a tool. Imagine a system of communicating vessels. If you pour water into one vessel, the level will rise in all the others. But what if one of the vessels is much smaller than the others? This is exactly how manipulation through small exchanges works. A whale creates a large movement on an exchange with low liquidity. The price changes drastically there. Arbitrage bots instantly react, transferring this movement to major platforms. But there are more complex schemes. Intermarket flows between different assets. When a whale massively moves funds from Bitcoin to Ethereum or altcoins, it creates waves throughout the entire market. You see that Ethereum suddenly started growing relative to Bitcoin. You think, great opportunity. But in reality, this might be the result of a large player simply rebalancing their portfolio. And in a few hours, they'll complete the operation, and prices will return to original levels. It turns out you're trading not real fundamental changes, but technical capital movements that are temporary in nature. Moving to one of the darkest sides of the crypto market, manipulation through information. In traditional markets, there are strict rules about information disclosure. Insider trading is punishable by law, but the crypto world lives by different rules. Here, news can be born in someone's imagination in the morning and move billions in capital by evening. Most frightening, most market participants don't even suspect they're being manipulated. Here's a typical scheme. A whale accumulates a position in a little-known altcoin in advance. Then, through controlled channels, rumors about an upcoming partnership with a major company begin to appear. First, it's discussion in Telegram chats. Then a tweet from an anonymous insider. Next, crypto bloggers pick it up. After all, content is needed daily and verifying information is difficult. Price starts rising. FOMO captures the market. Everyone wants to buy before the official announcement. Trading volumes grow exponentially. Then one of two things happens. Either the partnership turns out to be fiction, or the official announcement is much more modest than market expectations. Price crashes, the whale takes profit, the crowd is left with losses and disappointment. But there's also the reverse scheme, negative information dumps. When an asset needs to be bought cheaper, rumors about problems, investigations, technical malfunctions are launched. Price falls, creating accumulation opportunities. The most cynical thing about this system is that it works thanks to our human weaknesses: greed, fear of missing out, desire for quick enrichment. Now let's talk about the most spectacular manifestation of market manipulation: flash crashes. If you've traded with leverage, you know this feeling. Price moves in your favor, position is in profit, everything's great, and suddenly, in mere seconds, a red candle the size of a skyscraper. Your position is liquidated, stop loss didn't work, simply didn't have time. Flash crashes in cryptocurrencies happen regularly. Recent examples include Ethereum's 8% drop with subsequent recovery. But why do they occur? The official version usually sounds like algorithm malfunction or technical glitches. Sometimes this is actually true. But much more often, cold calculation stands behind a flash crash. Imagine a hunter who knows where deer graze. He won't run around the forest randomly, he'll set a trap in the right place and wait. Large players see clusters of stop losses at certain levels. This information is available through special services or directly from brokers. And they know, if you break through this level, a cascade of forced sales will trigger. The algorithm is simple and brutal. A large market sell order breaks through a key level. Stop losses trigger, creating additional selling pressure. Price falls even harder, triggering liquidations of margin positions. Within minutes, the market turns into a bloodbath. Tens of thousands of traders lose money. Meanwhile, the flash crash initiator is already placing buy orders at the very bottom. When panic reaches its peak, they scoop up assets at throwaway prices, then price begins to recover. Sometimes to original levels. Only a long shadow on the candle remains on the chart as a reminder of what happened. The most cynical thing about this scheme is that formally everything looks legal. No one was forced to trade with leverage. No one promised the market would move only in one direction. But it's not all hopeless. History knows many examples of smart traders who learned to play by the rules of large players and even profit from it. The first and main rule: accept reality. This isn't a fair game. This isn't a competition of analytical skills. This is a battlefield where the opponent has better weapons, more information, and unlimited resources. But you have one advantage: flexibility. Whales are slow in decision-making. They need to coordinate huge volumes, manage risks, consider multiple factors. You can be faster and more adaptive. The second rule: don't trade in obvious places. If it seems like you see a perfect opportunity, thousands of other traders probably see it too. This means large players already know about it and have prepared. Look for non-obvious entry points. Trade where the crowd hasn't gathered yet. Be a contrarian. Go against general sentiment. The third rule: study volumes and context. Don't just look at price, analyze who and why is buying or selling. Sudden volume increase without price movement, a sign of accumulation. Price growth on low volumes, a sign of manipulation. Anomalous activity at certain times of day may indicate large players from specific regions working. The fourth rule: manage risks like a professional. Never place stop losses in obvious places. They'll be collected there. Use positioning instead of leverage. Diversify not only between assets, but between strategies. Most importantly, be prepared to be wrong. Even understanding the rules of the game, you won't be able to win always, but you'll be able to minimize losses and maximize profits from successful trades. We've reached the end of our journey into the dark side of the crypto market. Yes, the picture turned out quite grim. Manipulations, deception, cynicism, all of this is the reality of the modern crypto world. But remember, manipulations aren't a bug in the system, they're a feature. In a world where there are no strict rules, whoever establishes those rules always wins. However, this doesn't mean there's no place for retail traders in this ecosystem. It means you need to play smart. Study the market not only from technical and fundamental perspectives, but also psychological ones. Understand the motives and methods of large players. Think several moves ahead. Most importantly, never forget that behind every price movement are real people with real goals. If you learn to see these goals and anticipate actions, you'll have a chance to play on equal terms. Want to continue studying real market mechanics? Subscribe to our Telegram channel. There, we analyze live cases, share stories, and teach you to see the market through professional eyes. And if you're ready to apply your knowledge in CFD cryptocurrency trading, visit the Strifor platform. More than 250 trading instruments, advanced analytics, and support at every stage of your trading journey. This was the Strifor channel. Remember, in the cryptocurrency world, it's not the strongest who survives, it's the smartest. See you in the next episode.